Did you know that one of the fastest ways businesses scale from small startups to major enterprises is through business loans? It's the financial jet fuel that can propel a brilliant idea from a garage project into a household name. Think about it. That capital injection is what allows a company to hire its first key employees, to purchase the inventory needed to meet surging demand, or to launch a marketing campaign that puts them on the map. It's the bridge between a founder's vision and market reality, turning what if into what is. But here's the catch, and it's a big one. While loans can fuel massive growth, they are a powerful, double-edged sword. If misunderstood or mismanaged, they can bury a promising business in a mountain of debt. It's a scenario that plays out all too often. An entrepreneur full of passion takes on a loan with unfavorable terms they didn't fully grasp. Suddenly, high interest payments begin to suffocate their cash flow. What was meant to be a lifeline becomes a financial anchor, dragging the business down. The dream of expansion turns into a nightmare of meeting payroll and dodging calls from creditors. It's not just about the numbers on a spreadsheet, it's about the immense stress and the sleepless nights that come when your financial foundation starts to crack. So, how do you know when a business loan is the right move? And when it's a trap? How do you confidently walk that tightrope between ambition and risk? This isn't just one question, but a series of critical ones. What's the real difference between a term loan, a line of credit, and invoice financing? How do you prepare your financial statements to impress lenders? And most importantly, how can you calculate precisely how much debt your business can safely handle without jeopardizing its future? These are the questions that separate the businesses that thrive from those that merely survive, or don't. Before we dive deep into answering those questions, welcome to Finance Code. We believe that financial literacy isn't a privilege, it's a necessity for every entrepreneur. Our mission is to be your trusted guide, your decoder ring for the often intimidating world of money. We're here to break down complex financial topics into simple, actionable strategies. We translate the jargon, demystify the numbers, and give you the confidence to make bold financial decisions. Think of us as the seasoned CFO you wish you had on your team, helping you unlock the secrets to sustainable growth and financial freedom. In this series, we're going to tackle everything you need to know about business loans. We'll cover how to build a stellar credit profile, how to create a loan proposal that can't be ignored, and we'll do deep dives into specific options like SBA loans and equipment financing. If you are serious about mastering the smart financial moves that separate amateur operators from professional empire builders, then I invite you to join our community. Make sure to hit that subscribe button and, just as importantly, turn on all notifications. Each video we release is a new piece of the code, a new strategy for your financial arsenal. By subscribing, you're not just watching a video, you're investing in your financial education and taking a crucial step towards building a more profitable, resilient business. Don't miss out on the insights that could define your success story. Let's start with the basics. A business loan is money borrowed from a lender, like a bank, credit union, or an online platform. It's a strategic tool, a formal partnership to fuel your company's future. The core purpose is to fund business operations, from day-to-day necessities like payroll to ambitious long-term growth initiatives. The goal is simple: provide capital to expand, hire staff, purchase equipment, or smooth out cash flow. Imagine opening a second location, investing in new technology, or bridging a seasonal cash flow gap. A loan makes these critical moves possible, but not all business loans are created equal. Let's break down the main types. First, the traditional term loan. You get a lump sum upfront and repay it with interest through fixed monthly payments. It's predictable and great for large, one-time investments. A business line of credit works like a credit card. You get access to a pool of funds to draw from as needed, and you only pay interest on what you use. This flexibility is perfect for managing unexpected expenses or short-term opportunities. SBA loans are backed by the U.S. Small Business Administration. This government guarantee reduces lender risk, often resulting in lower interest rates and more favorable repayment terms, making them a great option for small businesses. Invoice financing is for businesses with slow-paying clients. You can sell your outstanding invoices at a discount to get immediate cash, instead of waiting months for payment. It's about unlocking capital you've already earned. Finally, a merchant cash advance gives you a lump sum in exchange for a percentage of your future credit card sales. It's a fast funding option for businesses with high card transaction volumes, like retail shops and restaurants. Why should you consider a business loan? For many entrepreneurs, it's the fuel that turns a promising idea into a thriving enterprise. Let's break down the benefits. First, a loan provides capital for growth. Imagine opening a second location, launching a new product, or upgrading equipment to boost your capacity. This is how you scale. Beyond expansion, loans are critical for managing cash flow. A line of credit can act as a safety net, allowing you to pay suppliers and meet payroll during slow periods. It also empowers you to seize time-sensitive opportunities, like buying inventory at a discount. Finally, successfully managing a loan builds your business's credit history, making future financing easier to secure. But loans come with significant risks, and it's crucial to face them head-on. Let's not sugarcoat it. The most obvious is the debt burden. A monthly payment is a fixed expense that doesn't go away, even during a slow month. If revenue doesn't meet projections, that payment can suffocate your cash flow. Then there's the cost of borrowing. High interest rates can dramatically increase the total amount you repay, and the consequences of default are severe. If you put up collateral like equipment or your home, the lender can seize it. This can damage your credit for years and, in the worst-case scenario, lead to bankruptcy. So with these high stakes, when does it actually make sense to take on debt? The number one rule is this: only borrow when you have a clear plan for a positive return on investment, or ROI. This means the money must generate more profit than the total cost of the loan. Don't borrow on hope, borrow on data. A loan makes sense for a specific validated growth opportunity, like a machine that cuts production time in half, or a marketing campaign with a predictable customer acquisition cost. It also makes sense for hiring key personnel who will directly contribute to revenue. The key is that the investment is tied to increasing your bottom line, not just covering losses. Ready to move forward? Taking the time to prepare can be the difference between a great deal and a disastrous one. Here are 5 crucial tips before you apply. 1. Get your financial house in order. Have at least 2 years of clean financial statements ready. Lenders need to see a history of responsibility. 2. Write a detailed business plan. It must state how much you need, how you'll use it, and include realistic projections showing how you'll repay it. 3. Shop around. Compare offers from banks, online lenders, and credit unions. Look beyond the interest rate to the APR, which includes fees. 4. Read the entire loan agreement. Understand the penalties and default triggers. If you're unsure, ask a professional. 5. Stress test your ability to repay. What if revenue drops 20%? Can you still make the payments? Build a buffer for the unexpected. Ultimately, a business loan is a powerful tool. It can be the ladder that helps you reach the next level of success, or a pitfall that leads to crushing debt. The difference almost always comes down to strategic planning, thorough research, and honest self-assessment. By understanding both the opportunities and the risks, and by preparing meticulously before you apply, you can ensure that debt works for you, not against you. If you made it this far, thank you for watching. Don't forget to subscribe to Finance Code, where we decode money, investing, and business strategies every week. Drop a comment below. Have you ever taken a business loan? Was it a win or a challenge? We'd love to hear your story.